Welcome back to Talk Tickers, the show that helps you cut through the noise and get right to the heart of those all-important earnings calls. Today, we're diving into the world of home building with the latest report from Lennar, one of the biggest names in the game. We'll be taking you through their recent performance and highlighting what they see coming down the road. So, you're ready to break down the latest from Lennar?
Absolutely. Let's get into it.
All right, let's start with the headline numbers. What did their first quarter of 2025 look like?
Well, first things first. The results came out against a pretty tricky backdrop for the housing market overall. But even so, Lennar actually seems pretty happy with how they did. They're still sticking to their core strategy, which really revolves around that consistent sales volume and growth. And they're basically using adjustments to their profit margins as kind of a tactical lever to navigate the current conditions.
So stay steady on the sales front and be flexible on pricing when needed.
Exactly. But what really caught my eye were a couple of big strategic moves they made during the quarter.
Oh, yeah. Like what?
First off, they completed the spinoff of their Milrose business, distributing those shares to their existing shareholders, which really, underscores their commitment to moving towards that asset-light, land-light business model. And then they also went out and acquired Rouch Coleman. That move's going to expand their reach into some fresh markets, and again, fits right into that whole asset-light approach.
Interesting. So even with profits facing some pressure, they're still laser focused on selling more homes, even if it means accepting a little less profit per house right now.
That's the bet they're making. They seem pretty convinced that prioritizing that steady volume now will put them in the driver's seat to really capitalize when the market eventually stabilizes.
That makes sense, I guess, long-term thinking. So what's their take on the state of the overall housing market?
So Lennar is basically saying the macro housing market, it's still facing some serious challenges. Mortgage interest rates have just stayed higher for a lot longer than a lot of folks anticipated, and that's really put a damper on things. And they've definitely noticed a slowdown in what they're calling, and I like this term, actionable demand. Basically, people might still be browsing, but they're way less likely to actually pull the trigger and make a purchase.
Yeah, actionable demand. I like that too. Just because people are looking doesn't mean they're signing on the dotted line.
Exactly. And, this softening of the market has started to nudge average sale prices down a bit. Even after factoring in those sales incentives, Lennar's average sale price came in at $408,000 for the quarter, which is actually about 1% lower compared to the same period last year.
So a little bit of a price dip.
Right. But here's where it gets interesting. They're actually thinking that this whole thing, with housing inflation being kind of sticky, could actually be a good thing for the Federal Reserve in their fight to bring overall inflation down to that 2% target.
So a cooling housing market could give the Fed some breathing room on inflation. That's not a headline you see every day.
Definitely a bit counterintuitive. And they also pointed out that even though the fundamental desire to own a home is still strong out there, there are some real obstacles holding people back from buying. Affordability is obviously a big one, right?
Yeah, houses are expensive.
Oh, yeah. And beyond just the price tag, getting access to credit can be a huge hurdle for a lot of folks. Coming up with that down payment, meeting those income requirements that lenders are looking for. And, on top of all that, a lot of people are already carrying a lot of debt.
It's a tough cocktail for potential buyers.
For sure. And then you layer in the fact that consumer confidence has been a bit shaky lately, which makes people even more hesitant to commit to, a huge financial decision like buying a house, even if they're out there looking.
Understandable.
Yeah, it reminds me of when I was trying to buy my first apartment. Just scraping together that down payment felt like an impossible task.
Oh, I feel that.
And on the flip side, the supply of homes out there, it's still pretty tight.
Right.
They say it's because of, years of not building enough new homes. And with demand easing up, they expect this limited supply, combined with things like restrictive land permits, all those local regulations and fees, plus the fact that construction costs keep rising, could very well keep the supply picture constrained.
So not a flood of new homes hitting the market anytime soon. Okay, so we've got the demand side and the supply side. But what about the bigger economic and political landscape? Are they factoring any of that in?
Yeah, so they did touch on some of those broader forces, mentioning that recent tweaks to immigration policies and those new tariffs could potentially create some headwinds for the housing market.
Some potential wild cards out there.
Potentially, yeah.
Sure.
But they didn't really get into specifics during this call.
Okay, well, fair enough. So zooming back in on Lennar, you mentioned their two-pronged operating strategy. Could you break that down a bit more?
Yeah, so their whole approach really boils down to two core ideas.
Okay, let's hear them.
First, on the operation side, it's all about building and delivering a consistent volume of homes to really squeeze out maximum efficiency.
So keep that production line humming.
Exactly. And then financially, they're super focused on that asset-light, land-light model to generate that nice steady cash flow.
Makes sense.
And they made it super clear that spinning off Milrose has really allowed them to double down on both of these priorities.
Okay, so let's unpack that first part, the consistent volume piece. What does that look like on the ground?
So for Lennar, it means really fine-tuning their construction schedule to match their sales pace. And they're doing this at both the divisional level and at each individual community. The whole goal is to create this really predictable flow of work for their trade partners, because they think that predictability will ultimately translate into lower costs.
Right, because consistency usually means you can get better deals, smoother operations. It's like that in any business, really.
Absolutely. And in this last quarter, they actually hit their sales volume targets because they were really proactive about adjusting their incentives and their pricing in real time. And that let them keep selling homes at the pace they wanted without ending up with a ton of unsold inventory just sitting there.
It makes sense.
But they did acknowledge that this focus on volume could put a little bit of a squeeze on their profit margins in the short term.
Right, so they're prioritizing that steady flow of sales, even if it means taking a slightly smaller slice of the pie per house for now.
That's the trade-off they're making.
Uh-huh.
Looking ahead to the second quarter of 2025, they're projecting sales somewhere between 22,500 and 23,500 homes, and deliveries between 19,500 and 20,500. And they're expecting their gross margin for Q2 to land somewhere around 18%, which reflects that continued margin pressure.
18%, got it.
But they also shared some interesting insights into how those incentives are working. They pointed out that the current level of sales incentives, which is sitting at about 13%, is a big part of what's making homes more affordable for buyers right now.
So they're using those incentives to help buyers bridge that affordability gap.
Exactly. And they think that as the market stabilizes, those incentives will probably settle back down into that 5 to 6% range, and that could potentially boost their gross margins back up to like the mid-20s. So there's some potential upside there if things settle down.
Okay, so let's shift gears and talk about that second big piece of their strategy, the asset-light setup. This sounds like a pretty big change to how they operate.
It's a pretty significant evolution for Lennar. They're basically retooling their whole platform to become a much more pure-play, land-light, asset-light home builder.
So less about owning all that land and more about focusing on the construction, kind of like a just-in-time model.
You got it. The end goal is to have fully finished home sites delivered just when they need them, just like a factory getting its parts delivered right as they're needed on the assembly line.
Interesting analogy.
Yeah, and that Milrose spinoff, that was a huge step towards making this new model a reality.
Yeah.
So instead of tying up all their capital and land for years before they can even start building, they're working more with these land bank partners who basically take care of securing and prepping the land, making sure those build-ready home sites are delivered on schedule.
So they're handing off a big chunk of that upfront work.
Exactly. And each of those land bank partners will obviously have their own cost structures and ways of doing things, but Lennar believes that by working with a diverse group of them, they can refine their costs and efficiency over time. And they also think those land partners will benefit from Lennar's consistent, predictable building volume, which should ultimately help lower Lennar's overall costs too.
So a win-win in theory.
That's the idea.
Mm-hmm.
They're convinced this whole asset-light model will lead to more predictable growth, with less capital tied up in land and a lower risk profile overall. So it's a pretty interesting shift. It could free up their capital to do things like those share buybacks and dividends, but it also means they're more dependent on those external partners. It's definitely a gamble on streamlining their business and allocating capital in a different way.
Yeah, makes you wonder how it'll all play out. So let's look at how those strategic moves and the market conditions translated into actual numbers for their first quarter of 2025.
Okay, so in Q1, Lennar started construction on 17,651 homes, finished 17,834, and sold 18,355. And as we talked about earlier, sales incentives did tick up to around 13%, which landed their gross margin at 18.7%. And their general and administrative expenses, those came in at 8.5% of revenue, which put their net margin at 10.2%.
Okay, and what about those construction costs and timelines?
Well, they're actually doing pretty well on that front. They've managed to hold those construction costs steady, even brought them down a bit in some cases, and they've shortened their construction cycle times. And they actually beat their own expectations for both sales and deliveries. Yeah. Which is a good sign. They also expanded their footprint, growing from 1,447 selling communities to 1,584, which includes those new communities from the Rouch Coleman acquisition. And their projection for total home deliveries for the full year 2025 is still between 86,000 and 88,000 homes. So still a pretty big number.
Yeah, that's a lot of houses. So what's happening with their cash flow and how they're using their money?
Well, that consistent cash flow they've been talking about, it's actually allowing them to buy back a decent chunk of their own stock. They repurchased 5.2 million shares for a total of $703 million during Q1. And they're still paying out dividends too. And, like we mentioned before, they distributed 80% of those Milrose shares to Lennar shareholders as a dividend. The remaining 20% will either be distributed later or swapped for Lennar shares in what they call a cashless buyback. And at the end of the quarter, they had a solid $2.3 billion in cash on hand and a debt to total capital ratio of just 8.9%. So financially, they seem to be in a pretty good spot.
Yeah, it sounds like they're actively rewarding their shareholders even while making these big strategic shifts. You mentioned that their co-CEO, John Jaffee, gave some more color on the operational side of things. What were some of the key takeaways there?
Yeah, so John Jaffee dove into some of the nitty-gritty details. He said their sales pace in Q1 was 4.1 homes sold per community per month, which is almost exactly in line with their start pace of 4.0 homes started per community per month.
So they're keeping that production and sales pipeline flowing smoothly.
Yep, and he emphasized how focused they are on converting those online leads into actual appointments, and then, of course, into sales. They're really keeping a close eye on those metrics.
Data-driven, I like it.
And they're not afraid to use incentives to keep those sales moving. Things like mortgage rate buy-downs, price cuts, and help with closing costs. They've been using those strategically, especially in markets like Florida and Texas.
Makes sense. Those are some of their biggest markets.
Exactly. And they're also using a dynamic pricing model for those homes that are almost finished but haven't sold yet, just to avoid having too many unsold homes sitting around. They ended the quarter with an average of just 2 unsold completed homes per community, which is pretty impressive.
So staying lean on inventory, what about the construction side of things?
Well, they're actually seeing some really positive trends there. Their construction costs were 1% lower compared to the fourth quarter and 2.5% lower than the same time last year. That's actually the lowest they've been since the third quarter of 2021. And they're expecting that downward trend in costs to continue.
Which is pretty remarkable in this environment where everything seems to be getting more expensive.
For sure. And their construction cycle time, the average time it takes to build a home, that dropped by a day compared to the last quarter, down to 137 calendar days. That's an 11% improvement year over year. And they're hoping to shave even more time off that.
So getting more efficient, more homes built faster sounds like a good recipe.
Definitely. But he did say those sales incentives, which are sitting at about 13%, those are about 7 percentage points higher than what they normally like to see. But he said they were necessary to keep production going at their target rate. And he also highlighted how they're working closely with their trade partners to find ways to reduce costs and boost margins together.
Collaboration, key to any successful business.
Absolutely. And you asked really about tariffs and labor shortages, those potential challenges.
All right.
So on the tariffs, they've been proactive, talking with their suppliers, looking at different ways to source materials, getting their trade partners ready for potential price hikes. But so far, they haven't seen any actual cost impact from those tariffs.
So far, so good on that front.
Yeah, and as far as labor goes, he said that because they're building so many homes, Lennar is kind of a preferred customer for a lot of those trade partners, and they haven't run into any major labor shortages or seen any delays in their construction timelines because of labor issues. So that's a good news.
Yeah, definitely good news. And what about that big shift to the asset-light model? How's that playing out from an operational standpoint?
So Jaffee reported some pretty significant progress on that front too. Their own home site supply has shrunk dramatically, down to just 0.2 years from 1.3 years a year ago. But at the same time, the percentage of home sites they control, either through options or those land bank agreements, that's jumped up to 98%, up from 77% last year.
Wow, so a huge shift in how they're managing their land.
Yeah, big time. During Q1, their land bank partners picked up about 29,000 home sites for them for a total of about $1.8 billion, and they've got another $1.1 billion earmarked for land development. And Lennar itself bought almost 15,000 home sites directly from those land bank partners for about $1.6 billion.
So they're putting their money where their mouth is on this asset-light strategy.
Absolutely. And he stressed that their disciplined approach to starting construction only when they have those sales lined up is allowing them to acquire that land very efficiently. And they're constantly refining how they coordinate those just-in-time land purchases and development.
Makes sense, trying to minimize that lag time and keep things moving smoothly.
Yep. And their inventory turn improved too, which means they're selling and turning over their inventory of homes more quickly. It's now at 1.7%, up from 1.5% last year.
So they're not sitting on a bunch of unsold homes for very long. Okay, so lots of interesting operational updates. Let's turn to the financial picture and what they're forecasting for the next quarter. What did their CFO, Diane Bessette, have to say?
Diane Bessette started off by highlighting how strong their financial position is, ending the first quarter with $2.3 billion in cash and nothing borrowed on their $3 billion revolving credit facility. So they've got about $5.3 billion in total liquidity available.
So plenty of dry powder.
Yeah, they're in good shape there. She went over the financial impact of that Milrose spinoff, which, like we talked about, took a big chunk of land and cash off their balance sheet. And she highlighted how that acquisition of Rouch Coleman is expanding their market footprint.
Right. So big changes to the balance sheet.
For sure. And she echoed what John Jaffee said about their home site strategy. They ended the quarter owning just 13,000 home sites, but controlling a record 533,000. Their inventory turnover rate was 1.7 times, and the return on inventory was almost 30%.
Okay, some solid financial metrics there.
Yeah, they're doing well on that front. They had about 38,300 homes in inventory at the end of Q1, including those 300 finished homes that haven't sold yet.
So managing that inventory pretty carefully.
Seems like it. Now, for their guidance for the second quarter of 2025, they're predicting new home orders to be somewhere between 22,500 and 23,500, and deliveries in the range of 19,500 to 20,500 homes. And they expect the average sale price on those deliveries to be between $390,000 and $400,000.
So a slight dip in that average sale price in line with what we were talking about earlier.
Right. They're expecting their gross margin to be about 18%. With a little bit of a negative impact from purchase accounting related to that Rouch Coleman acquisition, about 20 basis points.
So they're baking in those acquisition costs.
Yeah, and they're forecasting their SG&A, their selling, general, and administrative expenses, to be between 8% and 8.2% of revenue. And they're expecting a small loss, about $15 million, from their core home building operations, those joint venture land sales, and some other miscellaneous categories. But their financial services division should be profitable. They're projecting earnings between $135 million and $145 million. And their multifamily housing segment should break even. The Lennar Others category is expected to have a loss between $25 million and $30 million, excluding any potential adjustments to the value of their tech investments. They're anticipating corporate G&A to be about 2% of their total revenue, a charitable contribution of $1,000 per home delivered, a tax rate around 25.3%, and a weighted average share count of about 261 million shares.
Wow, so a lot of moving parts there.
Definitely. And based on all that, they're expecting their earnings per share, their EPS, to come in between $1.80 and $2 for the second quarter. So they've given a pretty detailed outlook for Q2.
Yeah, lots of numbers to digest there. So for investors watching Lennar, what are the big takeaways from all of this?
I think there are several key things investors should be paying attention to. Their focus on sales volume over trying to maximize profit margins right now, that tells you they're pretty confident about the underlying demand for housing in the long term, even if the market's going through a rough patch right now.
Yeah, a bet on the future.
Exactly. And their move towards that asset-light model that's clearly aimed at using their capital more efficiently and reducing their overall risk. The fact that they're lowering their construction costs while everyone else is facing inflation, that's a big plus. And those stock buybacks and dividends, that shows they're committed to returning value to their shareholders, even while they're making these big strategic changes. And lastly, that big increase in the number of home sites they control through options and those land bank deals, that sets them up for potential growth in the future without having to sink a ton of their own money into buying land.
So playing the long game.
That seems to be the strategy.
Makes sense. All right, now for the fun part, our This Is Not Financial Advice segment. Based on everything we've unpacked today, what's your outrageous but plausible trade idea?
Okay, so given how much Lennar is emphasizing their land-light strategy, really leaning on those land bank partnerships, a potentially interesting, although definitely speculative, trade idea could be to go long on some of those publicly traded companies that are focused on land development and have strong partnerships with Lennar.
So basically betting on the companies that are supplying Lennar with those ready-to-build home sites.
Exactly. The thinking is that if Lennar manages to execute their high-volume sales plan, those land development partners should benefit directly, seeing more predictable demand for their developed lots.
So kind of like investing in the picks and shovels during a gold rush.
Yeah, you could think of it that way. But of course, this would take some serious research to figure out which specific land developers have those strong ties to Lennar. And you'd need to understand the risks that come with investing in the land development industry. But hey, it's a thought. And of course, just to be clear, this is not a recommendation to buy or sell anything. Just an idea to get you thinking.
Definitely a creative way to play it. Okay, well, that wraps up our deep dive into Lennar's first quarter earnings call. We've gone over their strategic moves, how they're doing financially, and their take on a challenging market. That shift towards the asset-light model and their commitment to selling a lot of homes, those are definitely the two big things to watch. What jumps out at you from this discussion? What questions does it raise for you about the future of the home building industry and where Lennar fits into all of it? This is just the starting point for your own exploration. Keep learning, keep asking questions, and remember, none of this is financial advice, but hopefully it's giving you a more informed perspective on what's happening with Lennar and the housing market.
It's been great unpacking all this with you.
Absolutely. Until next time.